Well, Robert, we're here in Warsaw talking about how Central European companies can deal with the consequences of over-leverage, which in some cases have been a long-standing problem. But from what we've been discussing today, it seems that there are structuring options and investor bases from well outside the region that could be brought to bear on Central and Eastern Europe.
That's correct. There's really a wave of liquidity in the capital markets, and it's made its way into special situations teams in a variety of classes of investors who are looking at growth markets. So there is money available to come in below where banks are now at a number of different levels, including preferred equity or subordinated or maybe secured, but one level, second type of lien. So there are a number of places in the capital structure that these investors are prepared to sit at. One can think that, for example, some bank debt could be repaid partially in exchange for some sharing of collateral or allowing a company to do more on its business plan. So these are commercial, global, relative value investors that one can work with to solve problems.
So it's interesting that they're prepared to come in, not necessarily senior to the existing banks. They will take these different capital structure positions. So what sort of return are they expecting in as compensation for that subordination?
Sure, it sort of depends on the underlying credit, but as I mentioned to a few people below, if you think of a single B credit in the public markets, so rated and liquid, in the 8 to 10% category, when you start to talk about illiquid amounts, unrated and subordinated, it's several hundred basis points higher. So it can go, it can go into the 15% category. Depending on some cases, it could go as high as 20. And people get scared with those numbers. But for a rapidly growing company, that is actually a small number compared to the returns to the shareholders if they're thinking in 3 years of selling to a strategic or doing an IPO.
So in terms of pricing, the comparison point isn't necessarily with other debt market instruments, it's with the cost of equity for the owner, the cost of equity for the owner.
That's correct. That's correct, because you basically have maxed out the debt. When you pledge everything and you go into leverage levels, when you start to talk about beyond 5 times EBITDA into 5 and 6, even if you have a profitable growing business, no bank can lend in that situation. There's no security, and you are subordinated to a whole other group. So you're really, the only alternative then is equity, and that has a certain cost, an inconvenience. So this can come in at another level.
And I suppose the crucial question then is, how do you find these companies?
Well, the companies are the investors.
Well, both. I mean, specifically the borrowers that you're working with.
Well, many of them are clients of the bank that we've supported for many years, and we take them to a certain point, and then they need more capital to grow, and we believe in the story. This is one place. The second is private equity firms. Many of them own these type of rapidly growing companies, and rather than put in more of their own money, they would rather leverage their return by bringing in some 3-year money at a level below their cost of equity. So that's another source. And then, good old plain fashioned cold calling, which we know how to do, or we try to team up with local institutions. There are many local banks in growth markets that have relationships and a network, but they don't have the product capability and knowledge of the investor base, and so we can team up together to solve their clients' problems.